afternoon, everyone. Mike over at Charts Don't Lie. I hope you guys had a wonderful Thanksgiving weekend with some friends and family. I wanted to put together a video for you all as I am seeing a lot of different opportunities and divergences in the market that are very interesting and to pay attention to. And I think we are going to get a number of actionable trades with some low risk and some high upside potential over the next few weeks. So I wanted to give a market overview, and the first place to obviously start is the big news-driven event over the last week, which was, of course, in the oil market. Now first, before I go into exactly what happened, I wanted to talk a little bit about risk management and reasons why it is really important not to play news-driven events, especially on the days that the market is not open. For starters, in the oil market, we were at about $108 a barrel a few months ago, all the way down to $73 a barrel. 30–40% downside in a few short months, facing extremely oversold conditions. People were looking to try and pick the bottom. We had a actionable trading bottom over the last week or two, about the 73.5 mark, where we had kind of put in that low, and it had been holding for a little over a week. So I know some people that did take advantage of that and tried to play here. However, with the OPEC announcement coming while the U.S. market was closed, unless you were playing in the futures market, you were going to face risk one way or the other headed into Friday, because that news was going to be out and the oil market was going to react. And subsequently, what we had saw was no supply change and a 10.5% sell-off on Thursday and Friday. So many oil stocks gapped down 10–12%, finished the day Friday at the lows for both oil and a lot of the oil producers. So there was a lot of blood in the street on Friday, and that is key as to why you have to define your risk and make sure that you're not playing news-driven events on days that the market is closed, because the risk is always there that you face a much bigger loss as something opens below your stop. Now, before trying to pick a bottom in the oil market, as I do think that there is some more downside pressure here, especially closing Friday on the actual low, we have to try and find support. If we go and we take a look at a weekly time frame, we are really in no man's land once we lost that 77 range a few weeks back. There really is no support over the last few years. However, if we do go back to a monthly chart, which most people do not look at, which is why we take a look at a monthly chart from time to time to try and find a level of support where we can actually take a chance trying to pick a bottom with a very tight stop in a small position can be very rewarding at times. So if we go all the way back to 1998, the 1998 lows in crude oil, and through the 2008 lows, we get this trend line. And while this may look very close in terms of a dollar perspective, it's actually about 7% more downside risk, which I think there's a good probability that we actually do see some, if not all, of that downside momentum into this week. However, once we do get to this area, there's going to be two things to think about. Number one, crude oil in a monthly chart has not been under 30 RSI since 1998. We are right now at 30.67, so we are almost oversold on a monthly chart as well. Any more pressure to the downside will drive that under 30, and that is often a place for at least a short-term bottom, if not the bottom. So I'm not going to call a bottom in the crude oil market, but we may get a tradable bottom. A good example of this is in the gold market from earlier this year. This is the reason why I picked up miners in December and January of this year. You had a low all the way back in 2001. You draw it through the 2005 low, and you got this trend line when people were looking for an area of support. It was very close, within a couple of dollars in terms of the gold market, and we saw a rally from that 1170 all the way up to 1390. So 2 months, 2.5 month type of trade where other people didn't see any sort of discernible bottom. were calling for a complete collapse in terms of the gold market. I found support where most people don't look, and that was on a monthly time frame. So we may get that type of opportunity in crude oil over the next few weeks while everybody is still calling for $40 and $30 and $20 a barrel, where we may find a spot to stop at least for a little while. As we all know by now, that was not the low in the gold market. That was a low. It was a tradable low. That's all it was. If we go and we look at gold on a daily time frame right now, the gold market looks extremely weak. We have a textbook bear flag with a strong breakdown. We got the same setup in silver. Silver was down, I believe, almost 7%, yes, 6.9% on Friday, which is a huge move down for silver. Now, if we are looking for an opportunity to go long here, I think we may get one over the next few weeks. I certainly would not be buying this dip. It looks like the bears have complete control unless we can get a surprise tomorrow out of the Swiss referendum vote. It looks like that's probably going to come across as a no. If we do get a surprise yes, that should have an impact, but most likely that is not going to pass from everything that I am reading. So it looks like the bears do have control here over the next few weeks. What we would be looking for is that 1130 type of low, looking for a double bottom low on the lower Bollinger Band. It may give us another actionable bounce trade inside of the gold market. This bounce trade that we took over the last few weeks, if you were in and out quickly in the miners and you leveraged up in JNUG, you saw a 70-80% return in 3 or 4 days. We may get another opportunity like that over the next few weeks. Another reason to think about that type of opportunity getting set up is taking a look at the dollar. Now, the dollar has been extremely strong over the last few months with a breakout of a multi-year downtrend. Very powerful move for the U.S. dollar. Now, if we take a look on a daily time frame, we've set up in another bull flag. In an uptrend, we've got this higher lows getting put in and this kind of resistance up here at 88, 0.36. If we can break 88.50 with any sort of conviction, I think the U.S. dollar can run to 90, 91, somewhere in that range, which would also correspond to continuing selling of gold. So you may actually see the U.S. dollar hit about that 91, 92 area, while gold kind of hits that 1130 area, and you may get a couple actionable trades both ways. Now, I am by no means trying to call the top in the U.S. dollar rise. However, there are some things to pay attention to. Number one, this is extremely overbought. The RSI reading is almost 80. Number two, everywhere you take a look in terms of sentiment is extremely bullish. You've got tons of dollars bet on the U.S. Dollar being stronger here. As we all know, the crowd is always wrong at some point. However, during the trend, they are right. So this could continue to run higher. I'm not going to necessarily step in front of the train. Even if the run doesn't end, we may get a little bit of pullback to the 10-week moving average, which, as you can see on the way up so far, has been very good support. So we may see another little push higher here over the next week or two, and then a little cooling off, and then it may even continue higher again. All we're looking for is that good opportunity where we can place a tight stop and take a trade that gives us a large risk-reward setup. Now, with crude oil selling off, a lot of people have been talking about the airlines. The airlines, if you look on a daily chart, they all gapped up, 5, 6, 7%. Southwest Airlines, Spirit Airlines gapping up, Delta, the whole industry did. And of course, it makes completely logical sense that with crude oil dropping 10.5% in a day, that the airline industry was going to see a benefit. The majority of their costs is in fuel. So if fuel is cheaper, that's going to give them higher profit margins, and that makes sense. Now, the thing to think about with the airlines is they have had an incredible run since the end of 2012. They're up 350, 400%. Delta is up 400% in 2 years. That is a huge move, and those are typically unsustainable. And we start to come across some bearish divergences in the airlines here. We have bearish RSI divergence where we're making new all-time highs here, but RSI is falling. So the relative strength behind the move isn't as strong. It would not surprise me to see a continued move higher for the airlines over the next week or so off of the cheap oil news. However, it is out of the upper Bollinger Band, and it's designed to trade inside of that range 95% of the time. It will snap back at some point. So I will be looking for any sort of weaknesses in the airlines to play, a pullback to an area of support. On Delta here, maybe this breakout test of 42.5 gets tested over the next week or two. That would certainly be a logical trade. And if oil can stabilize or it does bounce, the airlines may be a really good place to short. So that is just something to look at and keep in mind. Now, the overall market in and of itself, extremely resilient, strong bull market. We are running up in the S&P into resistance of this trend line from 2011. When it touches this trend line, it does not mean an immediate pullback. All it means is, as we have seen in the past, is it's not going necessarily above it immediately. We have had grinds higher for 6, 7, 8 weeks at a time. A few times we have had a little bit of a pullback of 4 to 5%. Right here, I would think that the upside risk versus the downside risk kind of favors a little bit of a pullback, or at least just a grind sideways. Plus, we have this big RHI divergence, which has been playing out over the last year or two. It's one of those things that doesn't matter until it does, and when it does, it has a huge impact. So I wouldn't necessarily be buying the S&P here. I wouldn't also be shorting. I would just be watching, be cognizant. If we do start to see some weakness here and a little bit of rolling over, we may be able to get a short trade in. The NASDAQ has been incredibly strong. It actually broke out of its trading resistance over the last 2 or 3 years. A part of that has to do with Apple's unbelievable strength. Typically, after a long move inside of a defined channel, if we leave the channel, we kind of start a new trend. If it's in the beginning of a move, towards the end of a move, a breakout can often lead to, if you want to call it, a blow-off top, where it will rise quickly, but eventually it falls back into this channel. Not going to chase on the short side here. I'm not going to chase on the long side here. What I'm going to wait for is I'm going to wait for it to re-enter this trend line, and if it does, I will likely take a short position to at least the middle of the trend line, which has been a very good spot to play to over the last few years. The semiconductors also have a very similar move here, where we have a breakout of the trading range that we've had since 2012. And once again, I mean, that indice is up 83% in that time frame. That's a very large move. Can this thing continue to really fly higher? Perhaps it can. Maybe we are starting a new extremely strong uptrend. But if you take a look at it, I mean, we have gone up 25% in the last month and a half. Typically, this is going to at least pull back, to that average that it has been riding most of the way up. So I would expect, some weakness over the next couple of weeks in the semiconductors that will give us an opportunity to short it to at least the 10-week moving average. I'm not calling a top. I'm not calling for an end of the bull market in any of these sectors and indices. I'm just simply stating they are getting overbought. We do have RSI divergences, and taking select shorts with a tight stop in place can be a very profitable move here, especially when one of the leading indicators in the market, the Russell, which is where people put a lot of risk when they feel like they want to take additional risk. So they will buy the small caps and the micro caps and the mid cap stocks. When we see the S&P and we see the NASDAQ and we see the Dow making all-time highs, and yet we see, the Russell not making all-time highs and still trading underneath of sort of that double top from earlier in the year, it warrants our attention. We do have sort of a little bit of a flag pattern here. If we kind of break out above that 1190 area, we can run for all-time new highs. However, if we break down underneath of this flag, we may see the Russell start to break down as people move money from the higher risk assets into things like the US dollar and the S&P and the Dow, etc., and into bonds. So this is where I'm really paying attention to. I'm not doing anything right here. If we break out above this to the upside, I will play for the long to test that 1210 area and see if the Russell can't make all-time new highs. And at the same time, if we break down underneath of it, I will be on the short side. the Russell has gone basically nowhere over the course of this year. I think it's now up maybe 1% on the course of the year. This does look like a kind of a year and a half, 2-year type of topping pattern. So, I just pay very, very close attention to the Russell and also to the micro caps as well to determine how much risk people are willing to take in the market. A very similar type of setup here where we are not making new all-time highs in the IWC, and we kind of have run into a line of resistance, and we're just waiting and watching. Over it, we can go long with a stop back at that, and underneath of kind of that rising trend line, we can go short with a stop at the trend line. We don't really have a trade right here in the middle, but we should get a trade one direction or the other over the next 2 weeks, so do pay attention to that. The IBB is the area in the market that I want to short the most. It has been by far the most undisputed, leader in the market over the last few years. A lot of the biggest winners in the market have come out of the biotechs. However, we have had a couple of very profitable opportunities to go short, one of which was earlier this year. We actually did short this on 2 different reasons. Number one, we had a big RSI divergence. We had an RSI reading of, I think, 86 and 81. While we're making all-time new highs, the relative strength isn't, and that's cause for concern. And the other is the IBB typically had tested the 10-week moving average for most of its move every 4 to 5 weeks. You can see 1, 2, 3, 4 test, 1, 2, 3, 4, 5 test, 1, 2, 3, 4, 5 test. That had been the pattern. We had been, we were in the 4th week with no test, and we were about 9.5% over the 10-week moving average, which during the entire run up, the IBB had not been that extended up to that point. So on any sign of weakness, which we got, we picked up a short in BIS and held it. We only held it back to the 20-week moving average, which is this light blue line, which was that other area of support. I didn't catch all the downside, and that was fine. We still picked up about 30% in 3 weeks on the trade with I think it was a 3.5% defined risk. Well, here we are again. We're 1, 2, 3, 4, 5 weeks without testing the 10-week moving average. We're about 8% from it, and if you look on a daily time frame, we've got this shooting star type of topping candle. This only is valid if we see downside pressure on Monday, and if we do, I will be picking up BIS. If we see more upside move, this candle is completely meaningless, just sort of like it was here. It only matters on the top or the bottom, so we'll be watching what it does on Monday. And again, the RSI divergence is just getting more and more pronounced in the IBB. So market, if we see some overall market weakness, the IBB is probably a good place to take a shot on the short side. The last thing that I wanted to take a quick look at would be the retail sector. We had built this higher set of higher lows from 2013 while running into this resistance here. When we broke out in August, I know a lot of people saw this and chased. If you didn't catch the move right away, once again, patience usually rewards you and rewards you well. You got another opportunity 6-7 weeks later where actually the resistance line had become support and the old support line was support, and they almost lined up perfectly on top of one another, and you got a very good low risk entry. And from there, we're talking 6 weeks later, we're up 15%. If you had chased, you have been holding this for 3 months and you're only up 12%. So patience definitely pays off, not only in terms of the percentage gain, but the percentage risk you have to take on the trade to where support is. And also you have that extra free capital. So during the course of this 7 weeks where it was just kind of holding sideways and doing nothing, your capital could have been worked elsewhere. Retail sector, very strong here at the end of the year with Black Friday and the holiday selling. So it will be interesting to watch. It is very extended right here. It's out of the upper Bollinger Band. It's been a straight up ride for 6 weeks. And, it's likely to not continue, at least not continue on this velocity. So this may not be the top, and I'm not saying that it is, but it is at a point where it is worth considering shorting over the next couple of weeks. I think, you got to watch this going into this week, seeing retailers' news in terms of how well their Black Friday sales went, Cyber Monday sales went, etc., and take a look at what happens. If you start to see some weakness, once again, You don't have to predict a crash. You don't have to play for a crash. You just play for a revision back to the mean. In this case, that's 7-8%. And the only risk you need to really take is the high of this day. So I can put a trade on if I see any sort of weakness on Monday where I've got a 0.5% risk to the upside here. And to the downside, I've got really about 7-8% to where I want to go. So 15, 16 to 1 type of risk reward, and that's what we look for. I will leave you with a view of the VIX. I did take a position in UVXY on Friday. I had posted this chart about 4 or 5 days ago. I've been waiting patiently for another opportunity to try and play volatility with all the divergences I'm seeing in the market and the setups that we currently have. Obviously, if the market starts to pull back here, the VIX will rise, and so UVXY and TIVIX are good places to play. This line of support has been in place since June. Every time that we've touched it, we've bounced. And I waited patiently for us to get that test again, and so we're sitting right here on it. I will set my my stop, and my stop is set underneath of kind of this low right here from a couple of weeks ago. So it'll give me that double bottom low, and that'll also correspond with the lower Bollinger Band. So even if it does fall just a little bit through this support, I'm still going to give it an opportunity here. However, as you know, with the volatility plays, they are just a complete erosion of value. They are only for short-term holds. You can't hold TIVIX and UVXY for any length of time, as they always get crushed. But if you are able to catch them quickly, you can see 100% upside move in 5-6 days. So here, my downside risk is about 4 or 5%, and I really am looking for a bounce. Back to about $3 in TIVIX, which is about a 25-30% upside. And on UVXY, which is the one that I actually purchased, I am looking for, about a 23-24 handle, which is about 20%. So, it's a 4-to-1 risk reward opportunity. And if I get stopped out, I get stopped out. It's not a problem. It's a very tight stop. So I want to thank you all for watching. I want to let everybody know I have picked up 5 students for the trade coaching. So I still have a couple of open spots. If you are interested, please feel free to reach out to me on StockTwits, or you can reach out to me through the website. There's a couple of different contact forms, and I hope you all have a good rest of the weekend. Just remember, keep your stops in place and wait for the trades to come to you, and I hope you guys have a profitable rest of 2014. Take care.